Usually when we look at an impressive architectural marvel, um, like a towering, ultra-modern glass skyscraper, we're completely captivated by the height.
Oh, absolutely. Everyone looks up.
Right. We look at the top floor, the penthouse, the gleaming windows reflecting the sun. I mean, it's designed to draw your eye upward. It represents success, growth, reaching for the sky.
Yeah, it's the ultimate status symbol.
Exactly. But you never see anyone stopping on the sidewalk to take a picture of the concrete foundation, buried deep underground. It's boring, it's hidden, and honestly, it's just not that glamorous.
Yet, if a massive earthquake hits, that invisible concrete is the absolute only thing that determines whether the glass tower stands strong or, shatters into a million pieces.
Wow, yeah.
The height of the building becomes entirely irrelevant if the base can't absorb the shock.
And today we're examining a document that applies that exact structural logic to personal finance. It's a deeply reflective piece originally titled Liquiditas Membri Wrong Bernapas, which translates to Liquidity Gives Breathing Room.
It's such a great title.
It really is. And our mission for this deep dive today is to explore a major paradigm shift. We're moving away from that exhausting modern obsession with maximizing every single penny of investment returns, and instead we're looking at how liquidity and daily cash flow act as the true foundation of financial resilience.
Which is something so many people overlook.
Okay, let's unpack this because whether you are a young family trying to budget, a seasoned professional, or just a beginner investor, the concepts here challenge the fundamental assumptions we're all taught about wealth.
Yeah, we really have to start with the ultimate paradox of modern wealth. I mean, society conditions us to look at high incomes, luxury cars in the driveway, sprawling houses, and immediately equate that visual display with financial strength.
Right, you see a Ferrari and think, wow, they made it.
Exactly. We assume the person with the massive stock portfolio and all that real estate has won the game, but that aesthetic of wealth usually masks a high degree of leverage.
Leverage meaning, sure, they have a high income, but they also have massive, rigid monthly capital outlays. The mortgage, the car payments, the private school tuition.
Yeah, their burn rate is incredibly high.
So it's like a beautiful mansion built right on top of a sinkhole. It looks spectacular until the ground shifts even an inch.
That is a perfect analogy. And what's fascinating here is the stark contrast between looking established and actually being secure. Behind the scenes, a high-income earner living paycheck to paycheck is structurally fragile.
Because there's no buffer.
Right. Their entire lifestyle relies on the assumption of a perfectly stable economy and an uninterrupted income stream. When an emergency hits, like a sudden round of corporate layoffs, a medical crisis, or even a localized economic downturn, the income stops, but that high burn rate does not.
And that is when the lack of resilience is brutally exposed. I mean, if you lose your job on a Tuesday, you cannot pay for your groceries on Wednesday with a fraction of your house.
No, you definitely can't.
You have millions of dollars in illiquid assets, but zero flexibility.
And let's look at the mechanics of what happens next, because it's catastrophic for wealth building. When you have a high net worth on paper but no liquidity, you're forced to sell assets during a crisis.
Forced liquidation.
Exactly. But crises are usually systemic. If you're losing your job, the broader market is probably panicking too. Real estate takes months to sell, and during a crunch, buyers just vanish.
Right. Nobody's buying a house when the economy is tanking.
And if you're forced to liquidate a volatile asset like your stock portfolio, you're selling at the absolute bottom of the market.
You're taking a massive haircut. You're locking in a 30 or 40% loss simply because you needed cash that week.
Yeah, you're selling from a position of desperation, not strength. And the market prices your assets accordingly. That forced liquidation completely wipes out years of compounding interest.
Ouch.
So the distinction becomes clear, right? Looking wealthy is about the assets you can show off during a bull market. Being financially resilient is about the options you have when the macroeconomic environment turns against you.
So if the goal isn't just to accumulate illiquid assets to look rich, we have to talk about how we view the cash we actually do hold. Because there is a massive psychological burden pushed by modern investing culture.
Oh, absolutely. It's everywhere online.
You log into social media, and every financial influencer is aggressively pushing the idea that every single cent you own must be put to work. Always be compounding. Leaving money idle in a checking account is treated like a total waste.
It creates a pervasive guilt. We're told that uninvested cash is lazy. But the breakthrough realization in the source document is that not all money is supposed to generate maximum profit. That is simply not its job description.
I understand giving your money a job description, but I have to argue the math here on behalf of our listeners.
Sure, let's hear it.
Inflation is a very real mechanism. If inflation is running at 3 or 4% a year, and my bank account pays zero, my purchasing power is actively degrading. If I hold $50,000 in cash, I am quietly losing thousands of dollars of value over time. Why would I want lazy money under those conditions?
Well, the math is entirely correct. You are losing purchasing power. But the framework here reframes how we view that specific loss. Instead of viewing it as a failure to optimize, you view that lost potential return as an insurance premium.
Wait, an insurance premium?
Yeah, you're paying a 3 or 4% premium to purchase peace of mind and optionality.
So the loss to inflation is just the cost of doing business in an unpredictable world.
Exactly. Think about your car insurance. You don't get angry at the end of the year because you didn't crash your car and, wasted your premium.
Right, you're glad you didn't crash.
Exactly. You paid for the protection against a catastrophic loss. The lost yield on an emergency fund serves the exact same function. Its job is to maintain your life's stability and prevent utter panic when your plans inevitably fail.
Wow, that makes so much sense. And the pandemic provided a brutal stress test for this exact concept.
It really did. When the global economy effectively froze, the theoretical yield on a stock portfolio meant absolutely nothing to someone trying to keep their small business open or pay their rent.
Yeah, those paper gains couldn't buy groceries.
Right. Having immediate accessible cash went from being viewed as overly conservative to being an absolute lifeline. The true value of an emergency fund isn't the nominal number sitting on your banking app. It's the psychological benefit.
The peace of mind.
Exactly. It's the ability to keep your head clear and think rationally when the environment around you is completely irrational.
Because panic is incredibly expensive. If your back is against the wall, you take on high-interest debt, you accept predatory loan terms, or you take a terrible job just to survive the month. The cash buffer buys you the time to make a strategic decision rather than a reactive one.
And understanding that psychological mechanism leads us directly into how we manage the money flowing through our lives every single month. It shifts the focus from the balance sheet, which is what you own, to the cash flow statement, which is what moves in and out.
Here's where it gets really interesting, because we naturally assume that someone generating massive investment profits is automatically in a healthy financial state.
Right. We see the high returns and think they're set.
But a high return on investment does not equal financial health if the underlying cash flow is a mess.
Let's break down why that is. Imagine an investor who hits a 50% return on a speculative tech stock. On paper, they're winning big.
Huge win.
But if their daily cash flow is chaotic, their expenses are uncontrolled, and they have no liquid buffer, they're still living under intense daily financial pressure. They're constantly stressing about bridging the gap between their next paycheck and their incoming bills. Their money is basically on a roller coaster.
And compare that to someone with perfectly average, maybe even boring index fund returns, but who maintains a highly stable cash flow and strictly controlled expenses. The latter person lives a much calmer life because they aren't constantly engineering short-term bailouts for themselves.
Yeah, exactly. Which explains why the document warns so heavily against the all-in mindset.
Right. The internet thrives on that extreme all-in aesthetic. I'm 100% in equities, or I converted everything to crypto, or even the doomsday version of being entirely in physical gold.
It projects conviction. It sounds brave.
It does. But that mentality completely ignores the reality of human existence. Real life does not care about your theoretical investment thesis. You can't hand a plumber a fraction of a gold bar when your water heater explodes at 2 in the morning.
No, you really can't.
And you can't pay your electric bill with a piece of a cryptocurrency wallet that is currently locked in some staking protocol.
Exactly. Life requires liquid friction. If you're all in on volatile assets, you're practically guaranteeing that you'll eventually face forced liquidation. Financial health isn't about being the most aggressive player in the market during a boom. It's about how much systemic shock your personal economy can absorb without breaking. Resilience over aggression.
So moving from the theory of resilience to the actual architecture of it, the source outlines the practical steps required to build this. And it begins with dismantling a very common, very dangerous habit, which is the single bank account.
Oh, the single account is a massive systemic vulnerability. Many people just dump their monthly salary, their long-term savings, their investment capital, and their grocery money into one giant pool.
It's like taking your winter coats, your daily t-shirts, your kitchen utensils, and your power tools and throwing them into one giant dark closet.
That sounds like a nightmare.
It is. When it starts pouring rain and you need an umbrella, you're digging through circular saws and spatulas. You have a huge pile of stuff, but zero functional access.
And the psychological danger of that dark closet approach is the illusion of wealth. When you look at your banking app and see a large aggregate number, you subconsciously feel flush with cash.
So you go out to dinner.
Right. You make discretionary purchases, completely forgetting that 80% of that number is already earmarked for next month's rent and quarterly taxes. It just destroys financial discipline.
So the structural fix is separation by function. You establish an operational account solely for daily and monthly liabilities, a dedicated savings account that's slightly harder to access, a separate channel for investment capital. But the architecture goes beyond just opening 3 checking accounts at the same local bank, right?
Yes, this raises an important question for you to think about. What happens if your single bank servers go down for a week? Or what if a regional banking crisis freezes deposits? True liquidity must be diversified across different types of systems.
The strategy detailed in the source involves splitting liquidity into physical cash, local savings, and importantly, foreign exchange or VALAs. Let's explain the mechanism of why foreign exchange acts as a layer of protection.
Well, if you keep all your liquidity in your local currency and a severe macroeconomic shock hits your specific country, your currency will likely devalue against global standards.
Right, inflation spikes locally.
Exactly. But by holding a portion of your liquid reserves in a major foreign currency, like, say, US dollars or euros, you create a counterweight. The foreign exchange retains its global purchasing power even if your local currency is suffering a temporary localized crisis.
So it's about analyzing how fast funds can be accessed, what form they're in, and whether they remain safe during abnormal events.
Yeah.
And there's a fascinating nuance in the document about how the author restructured their banking to align with their personal principles. Specifically, moving their main accounts and payroll into the Islamic banking system, or Bank Syariah.
Yeah, it's a critical layer of the architecture because it touches on both systemic risk and psychological friction.
How so?
Well, from a mechanical standpoint, conventional banking largely operates on fractional reserves and interest-bearing debt. During a systemic credit crunch, that model carries specific vulnerabilities. Islamic banking operates on a different structural foundation, primarily profit and loss sharing and transactions backed by tangible assets, because it prohibits the charging of interest.
So diversifying into that system isn't just about trying a new banking app. It's adopting a fundamentally different risk profile to protect against conventional credit shocks.
Precisely. It acts as systemic diversification. But equally important is the alignment of values. The authors sought a system that matched their ethical framework.
That makes a lot of sense.
When your financial architecture operates in harmony with your internal compass, you remove a massive amount of psychological friction. Achieving that peace of heart is a really tangible asset when you're trying to build a low-stress financial life.
I love that, peace of heart. And all of these operational changes, the functional separation, the diversified liquidity, the systemic alignment, they culminate in a specific framework. The document organizes this into the 4 layers of financial resilience.
This is the architectural blueprint. Layer 1 is liquidity. This is your immediate cash reserves, your physical cash, and your highly accessible emergency funds. It's the concrete poured into the ground.
Layer 2 sits directly on top of that, which is stability. This is your cash flow management. It means your monthly burn rate is significantly lower than your income.
Right, you're not bleeding out every month.
Exactly, which ensures you never have to drain layer 1 just to survive a normal Tuesday.
Then layer 3 is value protection. This is where the foreign exchange we discussed comes in, along with assets like physical gold. Now, these aren't meant to make you rich. They're meant to act as a hedge against currency devaluation and systemic inflation. They protect the purchasing power of your wealth over time.
And finally, layer 4, growth. This is the stock market, real estate, and ETFs. Now, an ETF, or exchange-traded fund, is essentially a basket of hundreds or thousands of different stocks. You buy one share, and you own a tiny slice of the broader economy. It's a fantastic engine for long-term compounding. But I really want to emphasize to you where this sits in the hierarchy. Growth is layer 4, It is dead last. It is the roof of the house.
And the order is entirely non-negotiable. I mean, modern financial media tries to get everyone to start at layer 4. They want you trading stocks before you even have a budget.
Always be compounding, right?
Yeah, exactly.
Yeah.
But you cannot build sustainable growth without protecting your value. You cannot protect your value without the stability of controlled cash flow. And you cannot have stable cash flow without the immediate liquidity to absorb shocks.
Right. If you try to build the roof before you pour the foundation, the structure inevitably collapses. If you're plowing every spare dollar into an S&P 500 ETF, but you have no emergency fund, you're one unexpected medical bill away from having to liquidate those investments.
Yep.
And because you're forced to interrupt the compounding process, you sabotage the exact growth you were trying to achieve in the first place.
You really have to protect the compounding engine from your own real-world liabilities. That's what the bottom 3 layers actually do.
So what does this all mean for us? It means redefining what financial success actually feels like on a random Tuesday morning. As we wrap up this deep dive, there's a quote from the original text that captures the entire philosophy. Liquidity gives breathing room when life starts to feel narrow.
And life will inevitably feel narrow at some point.
Okay.
Macroeconomic conditions change, industries get disrupted, personal emergencies happen, the pressure will squeeze you.
When that pressure hits, true financial freedom isn't about bragging rights. It isn't about pulling up a spreadsheet and showing off a theoretically optimized portfolio. It's about having the breathing room to make a rational, unhurried decision. It's knowing that when the ground shifts beneath you, your foundation is deep enough to keep the entire structure standing.
Absolutely. And I'll leave you with this final thought to examine your own financial architecture. Look at where your wealth is currently stored. If your primary source of income vanished tomorrow morning and the global market simultaneously dropped 20%, which of your so-called best assets would instantly transform from a blessing into a terrifying burden simply because you couldn't access their value to feed your family? Are you building a portfolio designed only for a perfect, uninterrupted world, or are you pouring a foundation resilient enough for the real one?